Foreclosure starts in Arizona are up 20% year over year, and in Phoenix's suburbs, it's even worse. Chandler, Gilbert, and Mesa are flashing distress signals, softening prices, rising delinquencies, and oversupply driven by overbuilding. So here's the real question. Is this a rare window for cash flow rental plays or a trap for late movers? Because as any seasoned investor knows, cash is king when the market crashes. And if you're waiting for the bottom, you may already be too late. In this video, you'll get exclusive 2025 data, discover where institutional buyers are quietly deploying capital, and learn how to position your portfolio before recovery momentum returns. Stay with me, because in the next few minutes, I'll reveal the 3 best suburbs in Phoenix to target distressed property with 6% rental yields. Let's start with the current conditions playing out across Arizona, and more specifically, suburban Phoenix. After a blistering rise in home prices between 2018 and 2022, things are now cooling sharply. The most recent CoreLogic report shows that Arizona's foreclosure starts are up 20% year over year, reaching nearly 5,000 properties statewide in Q1 2025. But that's just the headline. The real story is unfolding in the Phoenix suburbs. Look at this chart. Foreclosure spike, Maricopa County 2023 to 2025. You'll see a steep climb, with Chandler, Gilbert, and Mesa now making up over 30% of all filings in the state. Mesa alone logged more than 600 foreclosure filings in the last quarter, up from under 400 a year ago. That's a 50% increase, and we're not even at peak distress yet. So what's causing this regional surge? It comes down to a perfect storm of overbuilding, interest rate shocks, and a sudden pullback in migration from California. Between 2023 and early 2025, over 100,000 new housing units were delivered across Greater Phoenix. Builders raced to meet pandemic-era demand, but by the time these homes hit the market, interest rates had climbed to over 6.5%, killing affordability. At the same time, inbound migration, a key pillar of Phoenix's growth model, slowed dramatically. According to Zillow, net migration from California is down 30% from its 2021 peak. And with rates this high, buyers are holding back. That's why the National Association of Realtors now lists Phoenix's metro area inventory at 4.8 months, with suburbs like Mesa and Queen Creek edging over 5.2 months. Liquidity is evaporating. And consider this, affordability index, Phoenix Metro 2020 to 2025. We're now sitting at an affordability score of 75, down from 110 just 2 years ago. That's below every threshold investors watch. Median incomes simply aren't keeping pace with home prices and interest costs. The result? A growing wave of mortgage delinquencies, now at 4.8% statewide and over 6% in select suburban zip codes. But here's what investors often overlook. This isn't a housing crash in the traditional sense. This is a liquidity trap in a tight credit market, and that creates a distinct type of opportunity. You see, in markets like Chandler and Gilbert, properties are still fundamentally strong. School districts are solid. Infrastructure is in place. The problem isn't demand, it's access. Buyers can't afford 7% mortgages, so the only players left are cash buyers and institutional capital. That's where high net worth investors come in. Take a look at this chart. Cash buyer share. Phoenix suburbs, Q1 2023 to Q1 2025. Chandler and Mesa now report 38 to 42% cash buyer activity, up nearly 10 percentage points in just 1 year. And most of those aren't massive reds. They're individual investors, family offices, and overseas buyers from markets like the UK and Canada. From what I've seen in recent transactions, duplexes in East Mesa that traded for $500,000 in 2022 are now sitting at $420,000. Some even lower in foreclosure sales. At these price points, with suburban rents holding firm, you're looking at gross yields of 6% plus and net returns just shy of 5%, even after maintenance and property management. And check this out. Rental yield trend, Chandler, Gilbert, Mesa, 2022 to 2025. While prices are slipping, rents have remained resilient. Mesa now averages $2,200 per month for a 3-bedroom single-family rental. That's a strong rental base, even with rising vacancy rates in Phoenix proper. The key here is suburban stickiness. These are family renters, not transient tenants. Later in this video, I'll tell you exactly which 3 zip codes are showing the highest cash-on-cash returns for Q2 2025. But first, let's talk about positioning. If you're based in the U.S., a 1031 exchange into Phoenix REOs offers a direct path to defer capital gains, secure stable yield, and reset your portfolio for the next upcycle. For international investors, especially those from Australia or the UK, the key is understanding the tax overlay. Yes, FIRPTA and SDLT still apply, but many investors I've worked with are structuring purchases through U.S. LLCs or trusts to manage exposure and improve operational flexibility. Here's what most people miss. The big institutional players, Blackstone, Invitation Homes, and even some Canadian pension funds, are back in Phoenix, quietly. According to Bloomberg, Invitation Homes acquired 500 single-family homes across Chandler and Queen Creek in 2024 at a 17% average discount. Their thesis? Lock in 6% cap rates now and ride the recovery curve through 2026 and 2027. And if you're wondering what the upside could be, look at this chart. Projected home price recovery, suburban Phoenix 2025 to 2027. If JP Morgan's models are right, we're looking at a 5 to 7% bounce in late 2025 if rates stabilize and inventory tightens. But here's the key. The window is narrow. Many of the best deals, especially off-market or foreclosure inventory, are going under contract in less than 14 days, often without financing contingencies. Speed is your edge, especially if you can deploy between $500,000 and $2 million across 2 to 4 properties. From what I've seen since tracking this market in 2020, this type of dislocation doesn't last. Suburban Phoenix is a mean reverting rental market. Demand may be muted today, but the fundamentals, population growth, landlord-friendly laws, infrastructure investment, remain intact. And here's another insight. While many are waiting for a nationwide housing crash, seasoned investors know local dynamics are what matter. You don't need a macro collapse. You need micro volatility. And that's exactly what's happening in the suburbs of Phoenix right now. In the next section, I'll break down the 3 ZIP codes showing the highest inventory stress and the most attractive REO pipelines, and how to screen deals that institutions are ignoring. And before we wrap up, I want to leave you with one last strategy that's proving highly effective for investors in 2025, even in this declining market. It's what I call the liquidity gap edge. Here's how it works. While institutional capital is focused on portfolios over $5 million and retail buyers are frozen by financing constraints, there's a narrow band of properties, $400,000 to $800,000, especially in distressed suburbs like Mesa and Queen Creek, that are falling into a blind spot. These are assets too small for funds but too volatile for conventional buyers. That's where fast-moving, high-net-worth investors can seize position. Take a look at this chart. Phoenix suburb inventory versus buyer demand, Q1 2025. You'll see a clear divergence. Supply has spiked, but demand remains flat. That imbalance isn't going to last forever. When interest rates soften and buyer sentiment returns, likely in late third quarter or fourth quarter, this window will begin to close. From what I've personally seen working with investors in Chandler, the ones who act early are the ones who lock in yield, control the terms, and ride the appreciation curve once liquidity returns. You know how fast things move in this market. Waiting too long can cost you 6 figures in missed upside, or worse, leave you chasing crowded deals in 2026. So let's quickly recap the playbook. First, Foreclosure rates are rising, especially in Phoenix's suburban belt, but with them come rare buying opportunities. Second, institutional buyers are already moving quietly, absorbing distressed stock while retail demand is on pause. Third, cash buyers are winning by targeting REOs, leveraging yield, and bypassing financing altogether. Fourth, suburban rental yields remain stable, offering 5.5% to 6% returns even as prices soften. And fifth, timing is everything. The next few months could represent the last true buyer's market before recovery begins. Acting now means you can position ahead of the curve, secure quality assets at a discount, and lock in yield before the crowd returns. Delaying may mean watching the best deals disappear, either to institutions or to investors who simply moved faster. Which housing market do you think has the strongest upside in 2025? Phoenix, Texas, London, or maybe Sydney? Are you buying now, or are you waiting on the sidelines? Let me know in the comments. I'd love to hear your take. And if you don't want to miss the next wave of profitable real estate opportunities, hit that subscribe button now. Like this video if you found it valuable, and share it with anyone serious about strategic investing in U.S. housing markets. This is EstateScope. Global strategy, local advantage, no fluff. I'll see you in the next video.